Hello, good day. In the real world, there are occasions when prices of individual stocks can get out of line. There are also cases in which prices as a whole can no longer be justified by fundamentals. What are market anomalies and how do they come about? Do they support or refute the efficient market hypothesis? Advocates for rational and efficient markets also have a hard time explaining bubbles. Every decade seems to find its own bubble. The 1980s real estate and stock market bubble in Japan, the 1990s technology stock bubble, the real estate bubble that triggered the subprime crisis, and the Chinese stock market bubble of 2014 and 2015. The objective of this video is to enable students to identify and understand market anomalies and bubbles. From the knowledge, students will be able to find opportunities for stock market gains or avoid losses. Let's learn together. What is anomaly? Anomaly is a deviation from the basic proposition that the market is efficient. According to the definition of Bode, Kane, and Marcus, anomalies are patterns of returns that seem to contradict the efficient market hypothesis. It is an inexplicable pattern of abnormal stock return. In most instances, special or abnormal gains are achieved beyond what the market would normally provide, even after adjustment for risk. A number of anomalies have been identified. For example, small cap effect means the tendency of outperformance by small capitalization stocks. Small firm effect or size effect states that the size of the firm has a bearing on the level of stock returns. Indeed, several studies have shown that small firms earn higher return than large cap stocks, even after taking into account the higher risk typical of small companies. Value effect is the tendency for value stock to outperform. According to the value effect, the best way to make money in the stock market is to buy stocks that have relatively low price to earning or price to book ratios. There are a few types of calendar anomalies. Stock returns may be closely tied to the time of the year or time of the week. That is, certain months or days produce better investment results than others. January effect is a phenomenon of unusually large positive rates of return for stock during the first few trading days of the year. Holiday effect refers to unusually good performance for stocks on the day prior to market closing holidays. Monday effect is a regularity of Monday being the only day of the week that average a negative rate of return. Beginning of day effect is the tendency of stock prices to rise during the first 45 minutes of the trading day. On the other hand, end of day effect refers to tendency of stock prices to rise near the close of the trading day. In US, pattern of abnormally high annual returns during the third and fourth years of presidential administration is known as political cycle effect. Post-announcement drift is a predictable returns for a period after an announcement. Post-earnings announcement drift refers to phenomenon of stock price movement that continue after the earning announcement. Another market anomaly has to do with how stock price reacts to earnings announcement. Studies have shown that stock prices do increase quickly when an earning announcement is surprisingly good, but prices tend to drift in the same direction for many weeks after the announcement. This seems to indicate that investors underreact to the information in the announcement. Index effect is the tendency of stocks to jump when the stock is about to be added to the market index. There are also market anomalies associated with mergers and acquisition, the underpricing of new stock issues, and share repurchase. All these are examples of anomalies where abnormal returns have been achieved. This slide shows comparisons between value and growth anomaly. These two anomalies are in direct contrast of each other. Value anomaly derives abnormal return from stock with low price to earning ratio and mature companies. On the other hand, growth anomaly derives abnormal return by investing in stocks with high relative valuation but have strong growth potential. How can we explain the anomalies? There are two ways. First, rational model-based explanation, and second, behavioral explanations. Capital markets are episodically informationally inefficient. The existence of market anomalies may reflect misestimated or omitted systematic risks. Market anomaly studies may have methodological errors that make their conclusions unreliable. For example, data snooping. Enough snooping of a database almost always uncovers some factor or a set of factors that explain return over a given period. Most importantly, market anomalies may represent consequences of naive or irrational investor behavior. Next, we are going to learn about market bubbles. Do you agree with me that bubbles lie at the intersection between finance, economics, and psychology? Well, let's explore together. A bubble can be defined as an episode in which prices appear to depart from any semblance of intrinsic value. Normally, market bubble is identified after a tremendous inflation in prices followed by a dramatic decline. From the figure, we can see that bubble is an asset price movement that is unexplained based on what we call fundamentals or fair value. Fundamentals are a collection of variables that we believe should drive asset prices. In the context of a particular model of asset price determination, if we have a serious misforecast of asset prices, we might then say that there is a bubble. How are bubbles formed? History has captured some of the crucial aspects of a real-world bubbles. Most price bubbles start with initial good news, which generates substantial profits for some investor in an asset. In response to the initial increase in asset prices, smart money investor begins by increasing the supply of the assets. Of course, smart money investors take position in the desirable securities early on and even make an effort for organized front running. Smart money investors also create financial assets to take advantage of the noise trader, particularly in the later stages of the bubble, as they try to sustain noise traders' enthusiasm. At the very top, something more is perhaps needed to sustain the bubble, and this something in many cases is an authoritative blessing. Inevitably, these bubbles are followed by crashes, with huge losses for the noise traders who have held on to their securities. The crash of a bubble has often been accompanied by a severe financial crisis and depression. One final twist here is that many of the bubbles were followed by an extremely adverse political response aimed at both speculators and the organizers of the scheme. Kindleberger and Aliber highlighted 10 big financial bubbles in their book published in year 2005. The title of the book is Manias, Panics and Crashes. You are strongly encouraged to read this book to understand the major bubbles in history. In recent years, history continues to record many examples where rampant speculation caused a rapid boom in prices followed by sudden collapse. This slide shows a comparison between the fundamental value of real estate investment trusts in United States and its actual market value in the run-up to the subprime mortgage crisis in 2007. What do you notice from the figure? Do you think there is an obvious deviation from fundamental value? Is this a bubble? Did the bubble burst? I'm sure you have the answer. Do all bubbles look the same? Let's compare the bubble in US for the year 1929 and 1987. The axes on the top are dates in the 1920s, while the axis below represents dates in the 1980s. The value on the vertical axis represents the market index. The purple color line is the market performance in 1987, while the blue line is the market performance in 1929. What do you think? Are the pattern of the bubbles similar? Did history repeat itself? Are bubbles irrational? The term irrational exuberance was invoked by Alan Greenspan, the former chairman of Board of Governors of the Federal Reserve. When Alan Greenspan used the term irrational exuberance to describe the behavior of stock market on December 5, 1996, the world fixated on those words. As soon as he uttered these words, stock market dropped 3.2% in Japan, 2.9% in Hong Kong, 4% in Germany, as well as 4% in London and US the next morning. This event made for an amusing story about the craziness of markets, a story that was told for a time around the world. Robert Shiller defines irrational exuberance as the psychological basis of a speculative bubble. A speculative bubble is a situation in which news of price increase spurs investor enthusiasm, which spread by psychological contagion from person to person, and in the process amplifies stories that might justify the price increase and brings in a larger and larger group of investors. These investors, despite doubts about the real value of investment, are drawn in partly through envy of other successes and partly through a gambler excitement. There are other theories that explain bubble differently. According to the rational bubble theory, market participants believe that fundamentals are only part of what determines the prices of assets. There are other extraneous events that may well influence the price. Crowd psychology could become an important determinant of prices. Rationality of both behavior and of expectation often does not imply that the price of an asset be equal to its fundamental value. In other words, there can be rational deviation of the price from fundamental value, and bubble is actually rational. The greater fool theory is based on the idea that during a market bubble, one can make money by buying overvalued assets, irregardless of the fundamental value, and selling them for a profit later. This is because it will always be possible to find someone who is willing to pay a higher price. The speculative approach is predicated on the belief that investors can make money by gambling on future asset prices, and that investors will always be able to find a greater fool who will be willing to pay more. Unfortunately, when the bubble eventually bursts, which it always does, there is a last sell-off that causes a rapid decline in the asset value. Can investors profit easily from a bubble? The skill is obviously about knowing when a bandwagon is forming and to jump on it, and knowing when to jump off. However, selling at the peak of the market is very difficult. In the early stages of the bubble, the probability of it collapsing is low, but so are the returns. In the later stages, returns will probably be higher, but the probability of a collapse will be high. Most bubbles become obvious only in retrospect. At the time, the price run-up often seems to have a defensible rationale. In addition, security valuation is intrinsically difficult. Before I end this video, I would like to recommend this book to you. This Time is Different: 8 Centuries of Financial Folly by Reinhardt and Rogoff. This book is available in the online library. I hope you have learned something from this video. See you and goodbye.